Welcome, my name is Vishal Tekshilani. Today I'm speaking to Hamish Douglass, the Chief Investment Officer of Magellan Financial Group, and we're going to discuss some stock ideas as we turn to the new year. Hamish, it's such a pleasure to have you here. How are you?
I'm very well. How are you, Vishal?
I'm great, thanks, Hamish. So 2019 is just around the corner. Many investors might potentially be looking to rebalance their portfolios, redeploy some cash potentially. So why don't we start off with the tech sector and some ideas there. We've had a roaring start to 2018 for the FANG stocks and other tech stocks, fallen off a bit in the latter half of the year. What do you make of valuations in the tech sector, and what are some of the names that you like?
Well, first of all, the tech sector is a very, very broad term. So I probably don't have a view on the entire tech sector. There's many things in that sector as defined that we wouldn't invest in. But we do invest in certain technology-related companies that we actually have done a lot of research on, and we have a lot of conviction in their investment cases. And you're right, some of these share prices have gone up a lot in the last 12 months, actually a lot in the last 3 years. Some of them have come back materially, and some of them have come back very, very modestly in the last little while.
Yep.
So where are the areas in the technology sector where we feel that we have some expertise and businesses we think are super high quality, and ones where we're very confident where their businesses are headed maybe in the next 3, 5, 7 years into the future? I'd start in the two big advertising technology platform companies in the world. Alphabet's our largest investment at the moment. Alphabet, of course, owns Google. If you peel away the onion a little bit for some emerging businesses they have in their cash, I think you could quickly identify that Alphabet is trading at a very modest price earnings multiple, maybe in that 15 to 16 times sort of how we would look at the underlying adjusted earnings, and there's still enormous opportunities for Alphabet. Yeah, well, first of all, in their core advertising business, their search businesses, as we know it, they're doing a whole lot of things in relation to local-based advertising. So what they're trying to do is connect the user, which they know an enormous amount of information about, with the information on geolocation where they are, with the environment they're in at any point in time, which is local businesses. So with Google Maps and things like Google Lens, which they're now developing, and the information they have and geolocating, they'll be able to serve up very relevant information to a user as they're moving around on maps or when they're doing search. The results will be hyper-local, and it's sort of the holy grail for advertising. But of course, they've got a massive opportunity via their YouTube business for getting a large share, we would argue, of the advertising revenue that's currently sitting with television and paid television at the moment. So we still see an enormous advertising opportunity, and they have a number of emerging business. One is their cloud infrastructure hosting business called Google Cloud Platform. It's still very early days, but an enormous addressable market. They're really competing against Amazon and Microsoft in that business. And you've got an emerging technology, which is their driverless car technology. And I think that is really going to be a story for the next 10 to 15 years, and we'd expect Google to develop, or Waymo as their business is known, as one of the dominant sort of autonomous driving platforms in the world. And they're going to start with a sort of autonomous taxi fleet. That's going to be the first thing we're going to start. It's actually rolling out in Phoenix, in Arizona, in the United States at the moment.
Why don't we talk about some risks within the payments space? Because that's, I think, a theme that your investors are very familiar with, and I've certainly become very familiar with, the move towards a cashless society, people using more contactless payments, PayPal, etc. This year we've had the real emergence, I think, of blockchain, of cryptocurrencies, and there's been hype around that these technologies are going to replace existing payments infrastructure. So I'd love you to talk about the validity of that theme still. Is that a risk to payments companies?
Well, first of all, let's talk about the theme itself.
Sure.
You know, the move to the cashless society. There's still an enormous amount of commerce in the world that is undertaken by cash and check, and there's an inevitable transfer out. If we're looking at consumption expenditure, what is known as personal consumption expenditure, it grows at 5 to 6% per year. And then you've got this transition out of cash and check into more digital forms of payments, credit card payments, tap and go payments. Now you've got Apple Pay, e-commerce. When is the last time in e-commerce that you've ever done cash on delivery? It just doesn't occur. So this whole trend to sort of internet shopping, it's all been paid for in a digital form. There is no physical cash or checks being written to do this. And what's happening because of the transition, adding to just the fundamental growth in personal consumption expenditure, is growing the ecosystem maybe at 10 to 12% per annum at the moment. And we still have a very, very long runway of converting that cash and check into these cashless forms of payments. And nearly every underlying form of payment, the vast majority outside of China, gets powered by the two large payment networks, Visa and MasterCard. So if you want to pay on Amazon via Amazon Pay, you load your Visa or your MasterCard or maybe your American Express card. PayPal, 50% of their transactions go through Visa and MasterCard. If you want to use Apple Pay, you can load a Visa, MasterCard or an American Express card to your Apple Pay, and the same in Google Pay and Samsung Pay. So they are the rails that connect all the merchants and all the banking systems together with this underlying secular growth. That's another 10 or 15 years of growth into the future. You're asking the question of threats to the system, and there are regulatory threats. Are we worried about cryptocurrency per se? Do we think the world's going to start transacting as a fundamental currency in Bitcoin? We're not losing a lot of sleep on that. I don't think Bitcoin is a store of value. It is so volatile, I don't think it's going to take it over. And it's major threats to financial stability. I don't think the regulators are going to allow that type of currency to be the main form of currency at the end of the day. But are there forms of changes to the system that could in the long term threaten part of these payment networks? The answer to that question is yes, there are. I don't want to go into the full detail. All I'll say is that is something we don't think they're immediate. We think you get a lot of visibility of how these things are developing.
Let's take a different tilt. A consumer defensive play that you've nominated is Starbucks. Australians, perhaps not the biggest fan of their coffee, but why do you like it as a stock?
Yeah, why do we like it as a stock? And fundamentally, it's called China at the end of the day. Starbucks really has three very big businesses. It's got a very, very large core business in the United States. 65% of its earnings comes out of the United States of America. It is a dominant takeout coffee business in the United States. It's a habitual product that's addictive, that has a very, very loyal client base in the United States. And they're still rolling out 300 or 400 stores a year in the United States. More and more drive-thrus are coming. It's also got a very large business where they sell coffee to supermarkets in a package form and via pods. Like a Nespresso pod, slightly different to the Nespresso pods, but also to what is known as food service, putting their coffee into stadiums and hotels and businesses. This is predominantly a US business, a very, very good business, but they've just entered into a global alliance with Nestle. So they're effectively selling the right to sell those brands down those channels on a global basis, and Nestle's just paid them $7 billion. They're the largest coffee company in the world and the largest food company in the world, and of course they own Nescafe, but they also own Nespresso, and they're going to enable Starbucks pods and everything to be put through their whole global system. And Starbucks will pay a royalty on all. They will provide the coffee, Starbucks, get a margin on that and a royalty on sales, and of course Nestle is going to collect a royalty on those sales or a margin on those sales as well. So a very interesting alliance. And then it's China. They've got around 3,400 stores in China today. They're rolling out 600 stores a year in China. Yeah. There is 1 cup of coffee drunk per person per year in China. There are over 300 cups of coffee per person per year in the United States. Right. So they've got an enormous opportunity to keep rolling out stores, at least for a decade or more in China. They get ridiculous returns on their capital by rolling out new stores in China. They're getting around 85% pre-tax return on the cash they invest in the first year that they invest that. So it's a very attractive place to put capital. We think China alone, even though it's a relatively small part of Starbucks, maybe around 12% of Starbucks today is China, over the next decade, we think it's going to drive around 50% of Starbucks profit growth.
Now, I couldn't finish off the interview without asking you, 2018, it's been a volatile year for markets. What's been your biggest investment lesson this year that perhaps you'll apply as a New Year's financial resolution?
That's a really interesting question. First of all, I would say the lesson is we've had volatility, but we haven't had a market correction. And people are talking about a market correction. This
Yeah.
is not a market correction. So you need to make sure you distinguish between that. We're actually very happy how the year's played out. We actually like volatility. It opens up more opportunities and more things are being opened up. So when I think out a year ahead, we're expecting more volatility next year. We're going to have further interest rate rises in the United States. Who knows what happens between China and the United States? It looks like there's a truce, but that could easily blow up. So we would expect there'll be more volatility. And if I was going to have a resolution, it would be if we get that volatility, make sure you're bold and you take advantage of it. Okay. We've got 18% cash. So it's the famous sort of Warren Buffett saying at the end of the day would be my resolution. Okay. You know, be fearful when others are greedy and be greedy when others are fearful. And, you know, I think that would be my motto going into 2019. So if the world starts to wobble or markets really come off in 2019, you know, I think it would be time to get greedy.
All right, thanks. You're looking very hungry for some stock opportunities next year, Hamish. Love it.
We hope so.
Thank you so much for your time and for sharing all these invaluable insights with our investors. Really appreciate it.
A pleasure.
I hope you enjoyed this video. Now, please remember what we talked about today isn't investment advice. If you're thinking about investing in any of the opportunities that Hamish pointed out or looking at Magellan's strategies, it's really important that you do your research and please consider seeking financial advice. My name is Vishal Tekshanani. Have a happy holiday and see you next time.